Let's dive into Pine Labs, a key player powering India's digital payment revolution. If you've ever wondered how India's bustling shops and markets are able to accept so many forms of digital payment, Pine Labs is often the answer behind the scenes. This isn't just another tech startup. Pine Labs is the backbone of digital commerce for millions. From small family-run stores to massive retail chains, their technology is everywhere, quietly making transactions seamless and secure. Every time you tap your card or scan a code at a store, there's a good chance Pine Labs is making it happen. Their systems process billions of dollars in payments every year, making shopping faster and easier for everyone. They provide those point-of-sale terminals you see everywhere, but their real strength is a massive platform connecting merchants, banks, and customers. This network allows for real-time payment processing, loyalty programs, and even inventory management all in one place. From simple card swipes to buy now, pay later and EMIs, Pine Labs enables flexible payments right at checkout. This flexibility empowers both merchants and shoppers, making big purchases more accessible and boosting sales for businesses. In a country rapidly moving away from cash, Pine Labs is at the heart of this transformation. Their technology is helping millions of Indians embrace digital payments, whether it's through cards, wallets, or QR codes. They're not just participating, they're leading, with a dominant market share and deep integration into daily commerce. Their reach extends to over 150,000 merchants, covering more than 450,000 network points across India and beyond. For investors, this means sticky, reliable revenue and a business that's hard to disrupt. Their partnerships with banks and brands create a strong ecosystem that's difficult for competitors to break into. Pine Labs isn't just a story stock, it's a company with real products, real customers, and a tangible impact on the economy. Their solutions touch everyday lives, from metro cities to small towns. As India's digital economy explodes, Pine Labs stands to benefit massively. The company is poised to ride the wave of growth as more people and businesses go digital. Let's see why Wall Street is paying such close attention, and what the future could hold for this fintech powerhouse. Now, the main event. Wall Street's big guns are split on Pine Labs. The stakes are high, and the opinions couldn't be more different. This is where the titans of finance draw their lines in the sand, each making a bold call on the future of this rising fintech star. Jefferies is bullish, slapping a buy rating and calling for a rocket ride ahead. They see huge upside and urge investors to jump in. According to their analysts, Pine Labs is positioned for explosive growth, thanks to its innovative payment solutions and expanding market reach. Jefferies believes the company's fundamentals are strong, and that now is the perfect time to get on board before the stock takes off. But Morgan Stanley is more cautious, giving Pine Labs an equal weight rating, meaning they think the stock is fairly valued for now. They're not convinced the current momentum will last, and they're urging investors to wait and watch. For them, the risks and rewards are balanced, and there's no clear reason to rush in. Jefferies sets a price target of 300 rupees, forecasting a 23% upside. Morgan Stanley is more reserved, targeting 260 rupees, just a 7% gain. These numbers show just how far apart the two firms are in their outlook, and highlight the uncertainty swirling around Pine Labs' future. This split isn't just noise, it's a signal to dig deeper. When top analysts disagree, it's time to do your homework. The contrasting views mean there's more to the story than meets the eye, and smart investors know to look beyond the headlines. Why is Jefferies so optimistic? What risks does Morgan Stanley see? Understanding their reasoning can help you make a more informed decision, and avoid getting caught up in the hype or the fear. This clash gives you a balanced view. Let's break down both sides. Here's what's driving the bulls and the bears, and what you need to know before making your next move. Jefferies is fired up about Pine Labs' dominance and explosive growth in the Indian fintech space. The excitement is palpable among analysts, who see Pine Labs as a rare player with both scale and momentum. Pine Labs controls up to 95% of India's store-based EMI transactions, a near monopoly that's hard to challenge. This commanding market share gives them significant pricing power, a deep competitive moat, and the ability to set industry standards. Revenue jumped 29% last year to 22.7 billion rupees, and Jefferies projects it will soar to 42 billion by 2028, a 23% compound annual growth rate. That's not just growth, it's aggressive expansion, signaling strong demand and execution. The bullish thesis is built on more merchants joining the platform, more transactions flowing through Pine Labs, and a virtuous cycle where scale drives even more growth. As digital payments become the norm, Pine Labs is positioned at the center of this transformation. Losses are shrinking fast, and Jefferies predicts a swing to 7 billion rupees in net profit by 2028. That's a dramatic turnaround, showing the company's ability to convert growth into real earnings. With operating leverage kicking in, profits should accelerate even faster as revenue grows. This means every new rupee earned could add more to the bottom line, boosting margins and returns. Jefferies also sees Pine Labs as undervalued, trading at a discount to other Indian fintechs, despite its leadership and growth prospects. They argue the market hasn't fully priced in Pine Labs' quality, scale, and dominance. There's a sense that investors are underestimating just how powerful Pine Labs' position really is. As growth and profits ramp up, Jefferies expects the stock to catch up and reward early investors who recognize the opportunity before the rest of the market does. That's the bullish case in a nutshell. Pine Labs is a dominant, fast-growing fintech that could deliver big rewards as the market wakes up to its true potential. Let's look at the numbers fueling the optimism. Last year, Pine Labs processed 11.4 trillion rupees in transactions, over 5.7 billion payments. Their network spans 1.8 million checkout points across nearly 1 million merchants. Every new merchant and bank makes the platform stronger. A powerful network effect. Jefferies expects this to grow to 2.9 million checkout points by 2028. The affordability segment, EMI and Buy Now Pay Later, processed 2 trillion rupees, up 42% year-over-year. 40 credit partners power this growth, making big purchases accessible for millions. Their issuing platform is another winner. 713 million prepaid cards issued, 515 billion rupees processed. Once a retailer uses Pine Labs for gift cards, they rarely switch. Multiple revenue streams make Pine Labs resilient and ready for any economic cycle. That's why the bulls are so excited. Now, Morgan Stanley's take: cautious optimism. They like the business, but think the current price already reflects most of the good news. Their revenue forecast for 2028 is 38.1 billion rupees, still strong but less aggressive than Jefferies. They see net profit reaching 5 billion rupees, not 7 billion. Morgan Stanley expects higher costs and more competition, which could slow growth. Their valuation is more conservative, 28 times earnings, not 32. Bottom line, Pine Labs is solid, but the easy gains may be gone for now. Future upside will be harder to come by. Let's talk risks, because every investment has them. First, disruption. If new tech makes physical POS devices obsolete, Pine Labs could face a costly transition. Second, credit cycles. Their growth depends on banks offering easy credit. If lending tightens, transaction volumes could drop. Third, regulation. Sudden rule changes on fees or data could hit profits hard. India's regulatory landscape is unpredictable, new compliance costs could bite, and don't forget competition. Big players are circling, ready to undercut or out-innovate. Pine Labs' network is strong, but they can't get complacent. Staying ahead means constant investment and innovation. These risks are real, and investors need to watch them closely. Let's stack up the forecasts. Jefferies sees 42 billion rupees in revenue by 2028. Morgan Stanley, 38.1 billion. On profits, Jefferies calls for 7 billion, Morgan Stanley, 5 billion. The gap comes down to assumptions about growth, costs, and pricing power. Even on network size, Morgan Stanley is slightly more optimistic, 3 million checkout points versus Jefferies' 2.9 million. The real difference? Valuation multiples. Jefferies uses 32x, Morgan Stanley 28x. That's why their price targets diverge. It's a classic bull versus bear debate. Don't think Pine Labs is just an India story. International markets now make up 15% of revenue, up from 11% last year. They're expanding in Southeast Asia, the Middle East, Australia, and even the US. This global push reduces dependence on India and opens new growth avenues. Their issuing platform is a hit abroad, serving 28 international card issuers and 77 million accounts. Winning trust overseas proves their tech is world-class. Global expansion makes Pine Labs more resilient and valuable. For investors, it's not just a bet on India, it's a bet on a global fintech leader. That's a big deal for long-term growth. So, what's the verdict? Jefferies sees a dominant, undervalued growth machine. Morgan Stanley urges caution, citing risks and a fair price. Both could be right. Analyst ratings are opinions, not guarantees. Your job is to weigh both cases and decide what fits your goals and risk tolerance. Are you chasing growth, or do you prefer to wait for a better entry? There's no single right answer. It's your money, your call. Do your homework. Read both sides, check the numbers, and understand the business. Consider the risks and the global opportunity. The Jefferies versus Morgan Stanley debate gives you a roadmap. Now, it's your move, your portfolio, your rules.